Ryan Reynolds here from Mint Mobile. I don't know if you knew this, but anyone can get the same premium wireless for $15 a month plan that I've been enjoying. It's not just for celebrities. So do like I did and have one of your assistants switch you to Mint Mobile today. I'm told it's super easy to do at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Hi again. Welcome to Talking Real Money, the show that is trying to get you on track toward a much better future by helping you understand what investing's supposed to be about. And it's not what most people tell you it's about. It really is very different. Hugely different. 855-935-TALK is the number to call if you have a question, concern about your future, your financial situation currently, somebody suggesting you do. Call me before you do it. Get my opinion. You do what you want after that. But getting a second opinion never hurt anybody, particularly one that's free at 855-935-TALK. And even better, when it's a second opinion that also gets you a free copy of a book called Financial Physics, which I wrote, and I'll even sign a copy for you before we get that sent out. Take a couple of weeks, but you call, you get that for free too if you ask a question during the show at 855-935-TALK. 10 years ago last week, mentioned this last hour, we hit the bottom of the big bear market of 2008. The Standard & Poor's 500 got down to, get this number, it's kind of funny, or scary, 666. The S&P 500 was at 666 10 years ago. Where is it today? Over 2,700. Went up 2,100 points. More than tripled over that period of time. Is that right? Yeah, more than tripled. And yet a lot of people thought the world was coming to an end 10 years ago, and look what's happened since. You just never know. 855-935-TALK. Give me a call. I'd love to talk with you. Tom's in Phoenix, enjoying the warmth. I don't know if it's sunny, but at least it's warmer than Seattle. 855-935-8255. And let's get this hour on the road talking to Keith. Keith, welcome to Talking Real Money.
Hey, how you doing?
Very well. Thanks for calling.
So my question is, in 2018, I was contributing to a traditional IRA, and turns out I made a little bit too much money and can't take the tax deferred.
Oh, you got to recharacterize the money.
Well, that was my question. Is with the new tax law, I wasn't sure if I was still able to recharacterize that money that
you did it for what? For 2018?
Right.
And
so
you haven't filed your taxes yet?
Correct.
You can recharacterize.
Okay. All right.
You can recharacterize as long as you do it before your return is due.
Okay.
All right,
that
so
sounds good.
just take it out of there and put it elsewhere. Thanks, you'll be fine.
Thank you.
It's a minor loss, but congratulations on making a lot more money. I guess that's the saving grace of the whole thing. Thanks for calling,
exactly.
Keith. All right, take care. Bye-bye. Yeah, I don't know why they limit IRAs, Roth IRAs. They think that and it's at such low numbers too. Used to be that everybody was qualified, no matter how much you make. But no, in the case if you end up making too much, you have until you file your taxes to recharacterize it. Oh, it kind of stinks. But again, if you don't qualify for a Roth, if you don't qualify for a deductible IRA, remember, it's important. It's nice, but it shouldn't stop you from saving and investing. We sometimes cut off our noses to spite our faces over taxes. And you understand that if you invest in the stock market, I hope you understand, if you invest in a globally diversified portfolio of stocks, you're not going to have a lot of capital gains events, particularly if you're not in an actively managed fund. They tend to have a lot of them, but an index-style fund doesn't, because they hold the index through thick and thin. And if you're not happy with that, if you want even a little more protection, a lot of companies, Vanguard, for example, have tax-managed mutual funds where they go out of their way to avoid taxable events. They even go so far as to do some tax loss selling to offset gains. They do a lot of things to keep the taxes down so that you don't get hit with a big tax bill. So no matter what, whether you qualify for tax deferred or tax-free accounts or not, you should still be investing. And if you have to recharacterize your Roth or your traditional or whatever it might be, first it's recharacterizing a Roth into a traditional, but some aren't eligible for traditionals. Just get it invested. That's the key to a great future. And those who do that are the people who call me and go, hey, I'm really set for the rest of my life. You want to be one of them. So you need to get this right. 855-935-TALK is the number. Give us a call. Get a book.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
855-935-8255. Give me a call. I'm Don McDonald. Tom's at a ball game in Arizona. But I'm here to help you with your money. I'm here on Saturdays. Tom's here usually. And you can call us every Saturday from 3 to 5 Eastern Time at 855-935-TALK or noon to 2 Pacific, 855-935-TALK. But I also do podcasts throughout the week, so you can call during the week or any other time and ask a question at that same number, 855-935-8255. Quick, we were talking about the IRA limits. If you have a retirement plan at work, and you make more than $64,000, they start taking away your deduction. Once you get to $74,000, this is as a single person, it goes away completely. If you have a retirement plan at work, if you're married, it starts at 103, goes away at 123. And if you are not covered by a retirement plan at work, then you can, if your adjusted gross income, this is your modified adjusted gross, is under, where's the single person? Single. Any amount, you're good. If you're married filing jointly, it's 193 and goes away completely at 203. And that's for deductions on regular IRAs. And then on Roth IRAs, they're not deductible, of course. They just have contribution limits. And in 2019, they've modified these. You can make contributions to Roth IRAs, again, up to 193, and then it cuts off at 203 if you're a couple, and 122, it starts, then it goes away completely, the ability to put anything in at 137. And starting this year, also, the amount you can put into an IRA or a Roth is $6,000 if you're under 50, $7,000 if you're over 50. That's the catch-up provision. 855-935-TALK's the number. Tim, you're next. Welcome to Talking Real Money.
Hey, how you doing today, Don?
Good, sir. Thanks for calling. What can I do for you, Tim?
Hey, listen, I'm calling in actually for my son and for me. He said he heard, I think he said it was either you or 1 week or another, talking about trading, and he wanted to get into trading. So I don't know if he's got the right.
Yeah, I talk about I talk about trading all the time and how much I hate it.
Oh, okay.
Yeah,
that's what I was saying. Well, he was saying you talked about how much you loved it. So I said,
no. That wasn't me. No, that was probably a commercial for trading. I think trading is for fools. I think trading is incredibly dangerous. I think trading is almost a guaranteed way. Well, as a matter of fact, there are a couple of studies that were done on traders, and a really detailed one that was done in Korea, because they did it in Korea in South Korea because they could get all of the data on all of the trades, which they can't get here. And they found that I'm trying to remember the exact number, but it was about 10% that made money. 90% of traders lost money. Now, do you want to play those kind of odds? I give you better odds at blackjack. Tell him to count cards and go to Vegas and play blackjack. He has a better chance of winning.
I hear you. He said he heard it like trade wins. I guess he heard on one of the commercials. I don't know.
Oh yeah, there are commercials for all kinds of trading systems, but these guys don't.
Right.
Here's the interesting thing about here. You want to use a little logic on him? Try this out for size, Tim. If you had a trading system that guaranteed profitable trades all the time, would you tell me about it?
Yeah, right. Right. Would you sell it?
Yeah, I would not. Tim, if I had a system that I always won when I traded, I am not sharing it with you. You're just going to mess it up for me. No offense. I like you, Tim, but I'm not selling you my system.
Yeah. No, not me. Him.
Yeah, well,
I wouldn't buy it.
Tell him nobody is going to sell him a system. And how do they make their money? This is what's curious. Ask these guys, how do you make your money? Do you make it trading stocks, or do you make it selling me a $30,000 master class? Huh. I bet it's the $30,000 master class.
So you don't recommend any schooling to go to for that?
Zero. None. Good. in my humble opinion, protected by the First Amendment of these United States of America, sir, I say they're all scams. In my opinion. That is my opinion. I'm not saying they are scams. I feel they're scams. That's me. You may feel otherwise, but I got data on my side that says you can't win this game. And it's funny, they charge a flippin' fortune for something that, if it was that good, don't tell anybody.
But you've seen them advertise them, though, right?
Right? Gosh, yes. I know their ads are all over the place, and they're all over America. They're inundating the country because they make millions with their classes. Sometimes there are times, Tim, when I say, my gosh, if I had no conscience, I could be so rich. Because people are stupid. People are stupid.
Hey, thanks a lot. Appreciate you.
You're welcome. Thanks for calling, Tim. I appreciate it. I hate trading. It's just dumb. And okay, I was dumb once. I was a dumb 20-something. Weren't you a dumb 20-something? Yeah. You think you're smart. I traded options for a while. Guess what happened? I lost money. And I was a stockbroker. I supposedly had inside information. I didn't. Folks, you can't make a lot of money without a lot of work. It's just not possible. Forget about it. You can make a lot of money by working hard, working smart. You can make a lot of money by getting lucky. Tell me how that works out for you. Or you can make a lot of money cheating. And that's how a lot of these folks in the financial services industry make money. They make a lot of money by cheating you. They do. I mean, for example, there's this thing. It was just in the Wall Street Journal. Yes, here it is. It was in the Wall Street Journal today. There is a cryptocurrency company called OneCoin that has made billions and billions of dollars selling people their cryptocurrency through some membership system, multi-level marketing Bitcoin or something. Well, it looks like OneCoin may be a multi-billion-dollar. You go ahead. You say it. You know what I'm going to call it, right? Yeah, Ponzi scheme. Because people got greedy. you could get OneCoins without doing any work at all. They just sort of made up the value. And they claimed that they mined them using and had blockchain and all these things. No, they just took people's money, and if people wanted money from their money, they would use the new money coming in from the old people to pay the old people, or from the new people to pay the old people. What's that called? It's called a Ponzi scheme. Of course, they're only alleged right now.
Tom and Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information, talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-8255, 855-935-TALK is the number to call anytime, by the way, not just during the live show on Saturdays from noon to 2 Pacific, but anytime you can call that number. Leave your question. I'll answer it on the podcast, and the podcasts are at talkingrealmoney.com, which is in the midst of having a really big remodel, and I think you'll like the new way it works a lot better. It's complicated. It's hard work. Redesigning a website is hard work. It takes a lot of time. 855-935-TALK's the number. Give me a call. Mark, you're next. Welcome to Talking Real Money.
Hi.
Hi, Mark.
Hello.
What's up?
Hi. My question is on taxes. I have my wife's trust, and this year, doing the H&R Block, the form 8960 came up, and it's never come up in the past. And I don't know whether why it came up this year but didn't come up last year. Would you have any idea?
Was there were there some distributions from the trust?
Yes. In fact, for the last, whatever it is, 8 or 9 years, her trust has non-sheltered investments, and the capital gains for this year was about $93,000.
Well, I mean, the 8960, Form 8960 is for reporting net investment income from trusts. So either there was no net previously, but you think it's still, I don't know. I'm not a CPA, but my understanding is that if you have income from a trust, you probably should file one.
Well, it was. Wait,
hold on.
Okay.
I just remembered. I was talking to an accountant. No, you have to first calculate your net investment income. Then, if you have it, you must fill out a Form 8960. So, in previous years, you probably didn't net any investment income out of this. This year, you probably did. That would be my guess, but I would ask my H&R Block person why. That's my guess, and I'm pretty sure that's right.
Yeah, but I mean, over the past several, I mean, she's always had capital gains, and it's always been reinvested over the last several years. So if that
there must have been something that caused a distribution of income.
Well, it never was distributed.
Sure.
Yeah, it wasn't distributed to me. I'm assuming it was always distributed back, reinvested back into the trust itself.
It can be reinvested, but it still qualifies as net income.
Oh, okay.
Even though you don't take the money.
Pardon?
Even if you don't take the money.
Right. Because I haven't touched it. It's
mainly to determine the new. It's from the Obamacare thing. And it's to determine your Medicare additional contribution. That 3.8% Medicare contribution tax.
Right.
For high income individuals.
Mm-hmm.
And so this is why I hire people to do my taxes, because they make my head spin. One of these days, filing taxes will get easier. I just keep waiting for that day. But for now, you've got to feel if your tax accountant tells you need to do it, then there was a report somewhere, and just ask them to show it to you. Ask them to show you where the net income came from. But I'm sure it was from something inside the trust that probably got reinvested, but still qualifies and requires the filing of the 8960, which then goes toward your adjusted gross for calculating the Medicare tax.
For the trust, because it's all trust money.
Well, then for the trust, yeah.
Yeah, it's all for the trust.
Yeah.
Okay, well, has the 8960 been around a long time, or do you know?
No, it hasn't. It's been around only a few years. I don't know exactly when it started, but it wasn't very long ago. It was a few years back. It's not an old form. So I'm sorry you have to fill it out, but it's probably not a big deal. You probably don't have much, and it'll probably be a tiny little bit of taxes due, if anything. Thanks for the call, 855-935-TALK, the number.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at TalkingRealMoney.com.
Reality radio for a really great future. We're talking real money.
Welcome back to the show. I'm Don McDonald. We're talking about your dough on the radio at 855-935-TALK, 855-935-8255. Love to hear from you. And we can try to steer you in a better direction financially, and you get a free copy of Financial Physics, the book. And I'm Don McDonald. Tom's not here. He's down in Phoenix, where it's like 65 or 68 degrees or something, and he's watching a baseball game. He'll be back next week, though. 855-935-TALK. And Scott, you're next. Welcome to Talking Real Money.
Hello.
Hi, Scott. What's up?
Hey, I got a question for you in my situation. I think I know your answer's going to be, but mine might be.
Oh, darn it! I'm becoming predictable.
It's kind of the pay off the house or invest question.
I love this question. It's an important question because it's not easy to answer.
My situation is my wife and I are in a pretty good spot. I'm 49 years old. I've got MEBT, I got state retirement, I got all that. We've got quite a big chunk in savings. But I've got some inheritance money that is dang near the balance on the home.
Oh, what a coincidence.
So my question would be, our mortgage is about 4.25, and we've got about $600,000 in equity.
Okay.
And we only owe about
how much? I was going to say how much do you owe?
$214.
Okay. Here's the deal. You're 49 years old. I would assume you're probably raising a family in this house.
Actually, we did. They're older and gone now.
Wow, you're young for kids that are gone.
Well, we
started early.
Did the right
That's
thing.
Good for you. Yeah, no, send them on their way. But this is the question that really needs to be answered. Do you really believe this is the house you're going to stay in for the rest of your life?
That's kind of the question that we're talking about. Area, yes. The
house, probably
house?
not. Yeah.
No. We may bulldoze it and build something else on the same lot.
Oh, well, that's interesting. Here's the thing.
Because
right now you have over $500,000 that you literally can't get out of that house with any kind of a guarantee.
Right.
It's not liquid. That's a huge part of your net worth is illiquid. You're getting some more money as part of your net worth. Wouldn't it be better to have that liquid just in case? And probably making more money, no guarantees, paying more money than the net cost of the money you're paying on the mortgage. Because remember, you get a tax deduction off of that mortgage.
Yes.
And you can, if you invest that even relatively conservatively, let's say you went with 20% or 30% stocks and the rest in really safe bonds, your return, at least historically, would have been 4 or 5%. So you would have been money ahead, and you would have had liquidity.
And now, when you say liquidity, does that mean, that's a phone call away type?
Yeah, exactly.
Or?
It's a phone call away. When you invest it, you can liquidate it today and get it tomorrow. In your house,
it's not in an IRA or something.
No, even then you can get it. You just have to pay a penalty.
Yeah, well, that's okay.
But you can still get it. Think about it. Let's think about it for a minute. Let's say you have, I don't know how much you have in savings, but let's say you have $500,000.
I'll tell you, there's about $70,000 in savings.
Okay, so you've got, with this money that...
I currently have about $400,000 in retirement accounts.
Okay, we need to leave that alone. So let's just say... Let's say some horrible thing happens in your life, and you need $250,000 to save the life of your child or your wife or yours. It's going to take time to get it out of the house, or you're going to have to borrow it at who knows what kind of rate. If you have money invested somewhere that's not for retirement, that's not earmarked for anything else, but is still earning you decent money, I think as a financial decision, paying off the house just doesn't make sense.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
And this isn't just a hypothetical exercise, this business of paying off a mortgage or investing it. It isn't for me. As a matter of fact, it's very personal because just in the past few weeks, my wife and I have been looking at downsizing from a very big house in which we raised 4 children, 6-bedroom house. We look around and we go, the only room we use upstairs is our bedroom, and the rest of it's sort of wasted space. We had looked at a place. We found a townhouse we really liked. We did not end up closing on it because it had Chinese drywall. Like, I'm not going to buy a house with Chinese drywall, not from 2006. But we were really struggling over whether to take the money out of this house, which would have been more than enough to pay it off, or to carry a mortgage. And it really, from a financial standpoint, it just didn't make sense to pay off the mortgage, particularly when we found out we could get an FHA, because we're downsizing to a smaller house, less expensive. We could get an FHA mortgage at 3.6%. It was like, really? Seriously, rates are still that? Yeah, it was. We're not doing it, but it's how we ended up deciding because it had to be purely financial. It feels good to have a place that's paid for, but from a financial standpoint, it just doesn't make sense to have that much capital locked up. It's so difficult to get out. It's hard to get money out of a house. It can take a long time to sell a house. A mutual fund sells the next day. 855-935-TALK's the number. And Phyllis, you're next. Welcome to Talking Real Money.
Oh, am I on?
You are indeed. What can I do for you, ma'am?
Okay, well, they say if you invest long term,
yes, ma'am,
that you will, get 7% average annually.
No, I'm not going to give you a number because there's no way to know what the future will bring. But if you invest in equities, a 7% return would have been historically relatively conservative.
You mean that would be a conservative return?
It would have been in the past. I can't tell you what you're going to make in the future. There's no way to know.
Exactly, but what past? I mean, it depends upon 10 years you're talking about.
No. I'm talking about 90 years. I'm talking about 90 years. Over 90 years, the average annual return for stocks has been closer to 10%.
Okay.
But there have been periods. There have been periods where, for example, in the 2000s, if you just owned the S&P 500, you would have made no money whatsoever, zero for 10 years.
Exactly. So I think that in normal time, that wasn't very normal. In normal times, you would not make that. So I'm beginning to question, is 10 years really long term? I think that 15 or 20 years at least.
15 or 20 is better. 10 is fine as long as you don't have expectations. As long as you don't have to make X amount per year. You have to have flexibility. Otherwise, you shouldn't invest in equities. You should invest in bonds that pay 3%.
Okay, you gave me something to think about.
Okay.
Okay, thank you.
You're very welcome. Thanks for calling, Phyllis. 855-935-8255 is our phone number. Give me a call. We have a little bit of time left. I'd love to answer your questions, try to help you find a better path in your future, to a more comfortable future. We all desperately want to know the one thing we cannot know, but we want it so badly. We are willing to suspend disbelief, to become totally illogical, sort of stupid creatures. All of us. Me too. We all do this. To know what the future might bring. Now, most of us, although I read a study somewhere that said like 25% of Americans go to psychics. It's funny, I've had all these classes. I've taught thousands and thousands of people, and every time I say, how many of you go to a psychic to determine your future? And nobody raises their hand. Apparently, they're just embarrassed because 25% of you visit psychics regularly to determine your future, which is just illustrative of the issue we have with our little brains. You want to know the future, and you want it so badly, you're willing to stop being skeptical of ridiculous claims. And just as it's ridiculous to believe that a psychic can know your future, it's all a gimmick, it's all a game. You want to know how it works, just go online and type in the secrets of psychic readings. There's all kinds of tricks they use to make these readings. There was just a piece. What was it on? Oh, I don't watch that many things. Must have been on John Oliver's show. So don't watch John Oliver's show unless you don't mind language. Last week tonight on HBO, but I think they did a piece on psychics. It's all a bunch of bunk. And the same bunk exists on Wall Street. It's the exact same bunk. You know, when people tell you, and there's a guy on the radio, the most popular money show on the radio, although hard to find in Seattle, apparently, which makes sense because I'll tell you something, and this is no dig on the rest of the country, but I've lived all over the country, and the folks in the Seattle area, just slightly higher level of intelligence, I think. Just you guys are smart, and Dave Ramsey's not on. At least I couldn't. I mean, I saw he was listed on a station, but I couldn't figure out when he was on, which is good for you unless you're in debt. He's good for you if you got debt, but the dude is always saying you can expect a 12% return by going to one of our stockbrokers. No, you can't. That is so blasted irresponsible, Dave. It's irresponsible. Just as it's irresponsible for somebody to tell Phyllis, you can make 7% per year over 10 years if you invest long term. No, you might. I hope you do, but I don't guarantee it. There's no guarantee. Please get over this. All of you, please, 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 please. Renee, you're up next. Welcome to Talking Real Money.
Thank you so much. You've opened my eyes to something regarding the house, that the money isn't readily available. My other thoughts about a house we've been in ours over 30 years, so it's paid off. And right now, with a married couple, I'm wondering if the tax laws stay the same, where you get the $250,000 offset or exclusion for each person at the time of the sale of the property.
You do. You get the one-time capital gains exemption, for exclusion up to $250,000. Yes.
Okay, I wasn't sure if that still existed. Yep. And just like you, I have family in Arizona doing the Dodger baseball training.
That's where Tom is. He's at the Dodger game.
Oh, an actual game. I guess my brothers would be too.
Yeah, they probably are. Yeah.
Yeah. Okay. So it sounds like going back to the tax laws, it sounds like they're the same for the sale of the house, where you still get the capital gains exclusion.
You do indeed. You do indeed, and that's another. That's a real big benefit. You don't have to pay taxes on it. That's kind of nice. Thanks for the call, Renee. We're running out of time. I really appreciate it. We'll be back in just a minute. 855-935-TALK. Remember that number. You can call it anytime, 24 hours a day, 7 days a week, and leave questions for the podcast too, and I'll answer those on the daily podcast. So give us a call anytime.
Tom and Don are talking real money.
Would you like to talk to a real investment advisor for free? Set up an appointment at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And if you are a woman and you need a better understanding of finance and investing and the issues that really relate to women, you need to attend Female Financial Fundamentals on the 20th. It's a lunch ed thing. It's about an hour long, and you can get tickets right now, and you get a lunch at TalkingRealMoney.com, TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?